This is Advisor 3.0, a show designed to help you as a financial advisor elevate your professional practice, transform your clients' lives, and take your business to the next level. I am Abraham Okusanya. Welcome to the show. The global market cap weighting is still fit for purpose, especially in this age where the US now dominates that. US now accounts for 70% of the global cap weighting, and the Mag 7 accounts for something like 25% of the S&P 500. So this is a topic that keeps coming up over and over again. And with me to discuss that is Timeline's head of investment strategy, Laurentius who's done an incredible, insane amount of work on this topic. Laurentius, welcome to the show.
Thanks, Abram, and great to be here. And as you've said, it is a very topical issue these days in the industry, and probably rightfully or wrongfully so. I guess we'll discuss this in the next couple of minutes.
Yeah, no, I think it's good to challenge, our own assumptions and to look at this. So do you want to set the case? What is the case today for being global, for adopting global market cap weighting as opposed to, any other approach?
Abram, there are so many things to actually unpack as soon as you start to talk about why one would do it. I was at a interview a couple of weeks ago, and the guy asked me, if you have an active hat, what position will you take into your portfolios? And I was like, well, if I have a really active hat, I'll take the global market cap position.
Really?
And it's just a position that currently for me makes sense on so many areas. But first of all, to start with, what does global market cap means? It means, well, most people would say it means we are investing in each region according to that region's proportionate size of the global market capitalization. Now, that's wrong. That's not what we do. Because we are not investing in each region. We are investing in each company according to each company's size of the global equity market capitalization. And that's a very important point, because for me, it's somewhat irrelevant where that company is listed. You can have UK companies listed in the US, and we do have. You can have US companies listed in, well, Donald Trump wouldn't like it, but US companies listed in China. We've got a dynamic world these days. So that's what the global cap means. We invest in each company according to their size of the global market. And then also you have to think about, what does that really represent? That global market cap is essentially, and you do get a lot of pushback if you say that in the investment industry, but it is essentially sort of the point where all active decisions are in equilibrium. Right. And there was another conference where people asked me what's one of my convictions, and I just told them I've heard all these clever arguments about we should go into small caps, we should go into AI, we should go into whatever companies, and my answer was, well, my conviction is that you are all right, so I'm just going to buy the market. And that is how I see the global market cap. It is literally the collective wisdom of the market.
It's interesting when you break it down that way. Essentially what you arrive at is that all of the active decisions that are being made across all investors, that includes, active asset managers, institutional, asset managers, pension funds, insurance companies, I don't know the data these days in terms of the number of CFAs around the world. They are making capital allocation decisions, and they are valuing companies and then voting with their cash. So what we see in the capital market today, result of that is that they have decided to allocate 65-70% of their public market sleeve to the US and to US companies, and they've decided to allocate 4% to the UK, and there will be some people in that equation who overweight, and there will be some people in that equation who underweight. But what we see in the market is the aggregate collective wisdom of the crowd, if you like.
It is true, and you said you're going to play devil's advocate, but I think I can also.
I want to play God's advocate.
God's advocate. I think I can also play a little bit of a devil's advocate here. You've got the US market that is, in terms of global economy, by far the largest in the world, and you do have behavioral biases. I think that could possibly skew that global allocation, because if we talk about behavioral biases or a home bias, we all like to invest in the familiar. I think traditionally it stems from the idea that if you're an active manager, I know my market better than any other markets, I'm going to invest only in my market.
Right, so you're saying there's more capital in the US and US investors invest more in their market.
So we think we are overweight to US by having 62% exposure to the US. Go have a look at what the average American does. They've got probably about, and I think it's closer to 90% exposure to the US.
Right.
So they could possibly skew the global market cap slightly.
Yeah, but isn't that capital? In other words, so you would say, this is where the capital is, and so therefore they make a conscious case to allocate more to their own country. But surely they have the same insight, if not more, than other investors across the world, and knowing everything they know, they still they still decide to allocate more to their own country.
Exactly, and that is if you look at the fundamentals. At the end of the day, whether you've got a home bias or not, you're not going to invest in your home country if the fundamentals doesn't stack up.
Right. Yeah.
So that's now my active hat on. But if you're an active manager, if the fundamentals doesn't stack up, you're not going to invest in your home market. But if they stack up, and then you want to invest in the companies that's familiar in your environment, then you probably will do it. So that's one of the arguments I get for why we've got a bit of a skewed allocation towards the US. I don't buy it necessarily. I think it could have a minor impact. At the end of the day, active managers, analysts, they're going to look at what these companies are doing. And I think if we go into these companies, they are super, super attractive companies these days, especially these large. I don't even like to call it the Magnificent Seven, because I've heard people talk about the Magnificent Six these days. And but there are so many startups, and not even startups these days, that are multi-billion-dollar companies that are essentially in the same space, same valuations, and they are profitable, highly attractive companies.
We'll come back to the Mag 6 or Mag 7, in a sec, because you've done some work on that. But one thing I want to touch about on this home bias case is that, if your argument carries that most of the capital sits in a lot of the capital sits in the US, the US capital market is the deepest, most liquid, most dynamic capital market in the world. And so therefore, you make the case that US investors have home bias to their own country. Well, surely that should apply to UK investors, theoretically, who should allocate more to their own countries, and that should apply to the Nordic countries, who should know the companies in their own countries better and allocate more to their own country, and that should apply to Chinese investors, who in terms of population, we're talking 8 times bigger than the US, and therefore, they should allocate more to their own country, and they even have capital control. So this should balance out, but it doesn't, because if you I looked at this the other day. So we were both at the Northern Trust investment conference, and you remember I sat next to this guy who is manages a pension fund, AP3 I think is called, one of the
pension fund,
one of the largest pension fund in Sweden, and he said to me, I just allocate 60% or so of our allocation to the US. You look at, say, the another Nordic country, they publish their allocation. I think this is Norway, sovereign wealth fund. They publish their allocation on their website, and again, heavily weighted to the US. So my point is, if you make this case that this is, largely driven by home bias, well, why you would expect that other countries, including the UK, will make the same sort of home bias, and everything adds up. Everything balances out at the top. No?
I agree with you. And even if you think about it, let's say the average US investor goes from the US market cap is 60 and the average US investor invests 90%. That's about a 50% bias in terms of the allocation tilt. In the UK, we see that UK investors, the UK is about 4% of the global market, but they tend to invest about 22% into UK markets, which is a massive home bias. It's much more in terms of the scale of a bias that we see in the UK compared to the US. So yes, they will cancel each other out, and that is fundamentally why I agree. The global market cap, it's an equilibrium position. That is not just where... you can sort of see it as that's where risk and return should be in equilibrium, because that's everybody's decision. Home buyers, no home buyers, pension funds, those guys are not stupid. And by the way, I think the best comment from the person from AP3 when he's asked about where to allocate, and just like, well, I've got 26% allocation to private equity fund, and it's only because the board forces me. If I had my choice, I would sell it down to 0%. So and the reality is, these people are seeing so many attractive positions in the global markets, especially in the US at this stage, and they would like to invest there. That is the position that we get from fund managers outside the US as well.
I mean, we'll come back to this decision. Maybe that's a conversation for another day about private equity type investing, and the push in the UK, for instance, to get investors to invest, to allocate more to the UK, and also allocate something to sort of private equity to stimulate the economy. So you've done a lot of work on the Mag 6 or Mag 7, and you wrote a piece recently about their earnings, and you tried to compare that to the tech bubble, and then you wrote a piece even more recently about where you said, well, let's just stop calling them tech companies because they're infrastructure for the modern economy. Talk a little bit about this earnings position, and then let's talk about them being infrastructure for the global economy.
Yeah, so it's interesting. If we get the argument that what we are faced with now is very, very similar to the period just before the dot-com bubble burst in 2000s. And if you then, to make that argument, you have to really look at how does the current, let's say your top 10 companies or your companies that's in a bubble looks or compares against those top 10 companies back in 2000s. The interesting one is there's only one company from the top 7 or still in the top 7 that was in the top 7 back in 2000s. That's Microsoft. So well done to them. I know
it survived.
Intel was a big player back then. It's still up there, but not in the Mag 7. They don't have that crown yet. But if you look at a few things, first of all is the concentration. I think anybody telling you there's not a concentration in the market, they are just not being honest. There's a concentration in the market. These Magnificent 7 companies, I think it's about 35% of the S&P 500 as of today.
Right.
So it's a massive proportion. But then if you look at the actual fundamentals, what causes these companies to be inflated? One, they've got cash, about between 4 and 5% cash on their balance sheets. Now, if you think about the size of these 7 companies, to put it in perspective, excluding the US, these 7 companies are the same size as the equity markets of the 5 largest equity countries or markets outside of the US. So take UK, France, Germany, Japan, and what would be the 5th one? I believe India would probably be the 5th. But those 5 countries combined. And all the companies on those countries' stock exchange, they are the same size as this Magnificent Seven company. So they are massive. And then they sit with 4% cash on their balance sheets. So they do have that buffer, which they didn't have in 2000s. In the 2000s, it was about 2% cash. Talking about valuations, yes, valuations, especially if you look at your forward price earnings ratios, your forward lookings, and if you're an active manager, I guess all you have to do is you have to look forward, because everybody needs to believe in the crystal ball.
Yeah.
And if you do look at your forward price earnings ratios, they are elevated, 24, 25, that's more or less where we find an average, compared to your average. Let's say an average would be about 17, 18. But compare that to 2000s, we've had forward price earnings ratios of north of 50. So valuations were much higher. And then the main thing for me is earnings or profits. These companies are, and I think a couple of years ago we said some of them are profitable. We knew Amazon wasn't profitable. We knew Facebook wasn't profitable. These days, the Magnificent Seven, I think the lowest net profit margin is about 6% amongst the Magnificent Seven. The average profit margin, I can't recall the number from the top of my mind, but I think it's about 20%. They are really, really profitable companies. And compared to the dot-com bubble, they had a profitability of, I think it was about 8%. So the profitability is so much higher. And just based on that, you can make an argument that these companies are still good value companies. You don't have to look at the traditional value metric of price book or price earnings to say that these companies are attractive. They are really good companies driving economic growth.
Yeah, and I was just looking at some stats, that, although they might be 35, 37% of the S&P 500 market cap, they are 30% of the earnings, so they have it's not like, these companies are not making money. They are making huge amounts of money. The other thing, that you kind of touched on is, this idea of them being the infrastructure that powers the global economy. So the way I think about this today is to say, how many businesses today can run, without any of these Magnificent Seven in their lives?
Yeah.
Let's say that, so, and the people who listen to this conversation would do it through the interaction with the Magnificent Seven. So you're probably listening to this on your Apple podcast.
Yeah.
We're recording this, and Microsoft will be involved in the process somehow. I drive a Tesla, you drive a Tesla. Nvidia is there somewhere in terms of the chip. And so my point is, if you look at the UK capital market today, there's no technology sector, zero. We've outsourced our technology as a country, frankly, to US companies, and the same goes for European companies. So to think of them as just like, US technology company is not true, because, I don't know, you say 40, 50% of their earnings is actually from outside of the US.
Exactly. That's a very valid point, and that's something people need to understand when you invest in these companies. Your true exposure is, and before I say that, there will be noise in the short term. You are going to have speculative traders zoning in on the US and causing price disruption in the US over the short term. But over any meaningful period, the underlying fundamentals of those companies are going to drive the asset prices. And what are those fundamentals? Those fundamentals is those companies are making earnings not just in the US. They are making earnings globally. I think the only Magnificent Seven company that's, you can say, somewhat concentrated is probably Amazon.
Right.
There's about 70% of their revenue comes from the US. 70%, I would say, that is a concentrated position for Amazon. But then again, Amazon, I think these days people still think of Amazon as this parcel delivering company, but it's the backbone of the internet.
Yeah.
So it's so integrated into our daily lives. And then you think of your other companies. The largest one now, depends on what day you look at the asset prices, Nvidia. They generate, I think 2 years ago, it was about 15% of their revenue came from the US. Currently, it's about 30%. So it was a massive increase, but it's still a third of the revenue is from the US. 2/3 is from outside of the US. And then I think the second highest one is Apple, and it's about 51%.
Yeah.
So more than 50%, or let's say 51% and less of the revenue from these Magnificent Seven companies is in the US. The rest is all global earnings, and they are still making their profits globally.
And the thing, so we know that market concentration has always been a property. I think of it as a feature, not a bug. So market concentration has always been a key part of how returns in the capital markets is generated. Data, from 1929 till today shows that all of the returns that you get, let's say in the US public market, for instance, is dictated by 4% of all of the companies. So a handful of companies will drive majority of the return. 60% of public market equities historically, give you a loss. Another 30% of companies have been listed publicly will just return their capital back, and you have this 4% of companies who would drive all of the returns. They will make 20, 30x returns and pay for themselves and all the losses combined.
I've got a very interesting story, Abram, just to interrupt you there. Both of us were at a wedding in Edinburgh.
Yeah.
A colleague of ours, our wedding, and I was standing at the bar, and one of the guests came to me, and he's working for some large Scottish asset manager out there, and he came to me at the bar and he said, "So, Laurentius, you're one of those passive guys, right?" And I was like, "Yeah, absolutely. Why do you bring it up?" He was like, "You know what?" And he said, he actually said 3%. He said 3% of the companies are responsible for all returns over whatever period he referred to. Are you really comfortable buying the other 97% as well? And I just turned to him and I was like, are you really confident that you know who those 3% of companies are?
Right, exactly.
So that's sort of the conversation. And you don't need to avoid those other 97%, because those 3% companies, which by a matter of fact, you don't know who they are. Nobody knows who they are. They are going to drive the returns. They are going to give you a decent returns. And that's been the case not just now in the last 10 years. That's been the case for the last 100 years.
Yeah.
So nothing is new.
And as a matter of fact, the penalty that you pay for missing out on any one of those 3% of companies is infinitesimally bigger than the penalty you pay for holding the other 97. So in other words, if you missed Altria, Philip Morris used to be called, you miss out on picking that company, or you miss in this, more recently, Nvidia, you miss that out of your portfolio. You pay a huge price, because those companies would return, let's say, 1,000%, of your capital, versus the maximum you can lose on any single company that you hold is just your capital. So the upside, missing out, trying to this. I mean, it goes down to what my and yours, I hope, investment hero Jack Bogle says, which is don't worry about finding the needle in the haystack. Just buy the haystack.
Exactly. Yeah. No, it is really interesting. I would say though, Abram, it also brings up the question about. And I've had a very interesting conversation with an investor a couple of days ago, which talked about, and I tried to explain my thinking to him, and he is in finance, and his wife is in finance, and they told me, well, even if you are right, and what I explained to him, because he told me what we are facing now is not a 2020 scenario where we're gonna have a 3 months recovery after a bear market. We are facing structural challenges, more like a GFC or a .com. I was like, okay, it's interesting that you mentioned that. Let's pull up the GFC and the .com bubble. Your bear market lasted I think the .com bubble was 2 years and 7 months, and the GFC was 2 years and 3 months to full recovery. And I was like, do you call that a structural change? And if 2 years and 7 months is too long for you, then you shouldn't be in the markets in the first place. But he then went on to say, I agree with you, but the matter of the fact is, if there is going to be a market correction, and I have to caveat that, it's possible.
Yeah,
we know there will be market corrections.
At some point, yeah.
That's one of the few things I can guarantee you. There will be a market correction. We don't know when. And his argument was, if there's going to be a market correction, and I had the view that there will be a market correction, I won't be able to sleep at night. So I don't want to stay in the market now. And then you can start to have the conversation, because for somebody like that, I fundamentally believe it is always in your best interest to stay invested.
Yeah.
For somebody like that, you can then say, okay, is there an alternative to the global market cap? And I do think there is. I do think not necessarily to de-risk yourself, but if you tilt your portfolio, I always say profitability is the common sense thing. If you want to tilt your portfolio to your more profitable companies, value companies, size, you get all these other factors as well. I see it sort of a enhanced index approach. It's not a active, we're going to pick specific stocks. It's just a rules-based approach to redefine your index. But the main thing is maintain your exposure to all these companies. Don't sell out completely.
So let's talk a little bit about that. So let's talk about this case. If you want to tilt away from, these large companies or from the US. So, and in our case, we have the tracker portfolio, which is like 100% global cap weighted. Last I looked at this, you would have 65% of your portfolios in the US, and the top 10 holdings will be like 20%. And then you have an alternative approach, which is the classic portfolios that we have. And what you end up with is you overweigh value and small cap within that equation, and maybe overweigh what? Emerging markets or Europe or the UK. Would you do that? How would you go about this? Talk about that in terms of if you want to quote and unquote move slightly away from the global cap weighting.
So first of all, I would ignore country allocation.
Right.
Because I do not think, and there's a lot of noise from our friends all over the place talking about your exposure to this country. As I've said at the start of this session, I think it's irrelevant. It's just a country where a company goes to list. That's it. What I would do is, if you think about a evidence-based approach, and I have to give it to you, when I came over to the UK 4 years ago, you were on a podcast with Robin Powell and talking about evidence-based investing. And you, for the whole podcast, you almost just talked about our tracker portfolio. And having then be neck deep into the CFA curriculum, I thought to myself, evidence-based investing, factor investing, and you are just talking about the tracker portfolio. You guys are missing what evidence-based investing is. And the fault was actually with me. I figured out it took me a couple of weeks after having a deep dive into our tracker and our thinking behind our investment philosophy to figure out a tracker strategy is the very start of an evidence-based philosophy. People always, and if you want to be academic, you can explain why it is, but people always thought about your investment returns must be a direct result of how skilled the investment manager is. And it took William Sharpe in 1964 to come to the party and say that's not the case. Your skill is almost zero, or the contribution of your skill to your returns is almost zero. It's the risk that you expose yourself to that gives you your return. And that risk was defined as the market, the tracker portfolio. So it is an evidence-based portfolio. It was the first risk factor ever to be identified. And that's why I like the tracker portfolio, because I can quantify my risk. I know what I should be able to expect from the markets. But then you can take one step further and say, okay, I've now quantified my exposure to the market, to that market risk. What other risks are there that I can expect compensation for? And that's where you get these size premiums, profitability premiums, momentum, low volatility. If you really go into it, there's literally thousands of risk premiums these days because it's sort of a buzzword. But let's stick to the old traditional ones. Value companies, companies on a discount. They should mean revert. Small cap companies that don't have the upside ceiling. Companies that are profitable should outperform companies that are not profitable. And the thinking is, what you do is you buy the market. The market is going to do the heavy lifting. And then all that you do is you take that portfolio and you tilt it towards these value size or smaller cap companies and profitability. And the way you do it is you rank your whole investment universe, you give them a value score, give them a size score, give them whatever factor you want to invest in, give them a score based on the highest factor score. You just slightly overweight or underweight those companies. That's all you do. So it's based on exposure to risk. Smaller companies are more risky than large companies, even though these days your large companies has been extremely volatile. Small cap companies are more risky. They are more susceptible to things like interest rate movements, profits, etc., economic recessions. So you expose yourself slightly more to those risks, and then you should expect a higher expected return over time. But remember that risk means you can go through very long periods of underperformance.
And that's what we've seen, isn't it? That we've seen in the last, let's say the last decade, that, whereas you would naturally expect that smaller companies would outperform bigger companies in the long run over a 10-year rolling period, 80% of times you would expect smaller companies to outperform bigger ones, value companies to outperform growth companies, let's say, and, more profitable companies to outperform. That hasn't been the case. So I always say to people that risk factor is called risk factor for a reason, because there are going to be these periods of, prolonged underperformance. And if you're not prepared to take on that additional risk exposure, then you shouldn't do that.
Exactly. And it's a very important point that you make there. So we were talking about the Magnificent Seven and what else can you do if you are uncomfortable with that. It's really important to say you do not go into risk factors to de-risk your portfolio. You do that for the higher expected returns that you could empirically and academically expect from it. If it gives you that behavioral comfort, then it's an added benefit. But don't think you're going to de-risk your portfolio. They are more risky, and that risk is, as you've said, it's not volatility. Volatility isn't a risk. Your best performing companies or your best performing assets are usually the ones with the highest volatility, because volatility is being captured on the upside as well. Your real risk is, and you wrote a whole book about it, is that sequencing risk. That risk of those stocks not doing or giving you any returns for an extended period of time. And then you have to ask yourself, can my financial plan withstand it? And you have to stress test it. For some people, probably for most people, they will be able to withstand it if they really have a look at their full investment journey. Then they can tilt towards these value factors. You can expect, if you look at your risk factors, the value premium underperforms the market. When I say underperform, I don't mean negative returns. It underperforms the market roughly about 20% of the time. 1 out of every 5 rolling 10 years. But that's a 10-year underperformance.
It's a 10-year.
And small cap even worse. About 25% of the time you get 10 years of underperformance. And we've seen value now. Value had a really strong comeback. Over the last 5 to 6 years, value have actually stayed on par with growth stocks. And then if you strip out those outliers that we've seen from your Magnificent Seven, value has completely outperformed growth companies over the last 5 years. Small cap are the ones that's still lagging, but we know the last 5 years we've been through with COVID, high interest rates, inflations. That's not the environment for small cap stocks, and why we've seen small cap stocks underperforming for the last 10 years. This year they've done actually much better. Profitability, I think, is sort of that's the one factor that I don't like to call a risk factor. Because why are companies that are profitable more risky than companies that are not profitable? And the funny part is it took us until 2011 to academically or statistically determine that it's a risk factor. Companies that are more profitable should outperform companies that are less profitable. But yes, they are more volatile, again, because they have higher returns. But I see sort of that profitability piece as that risk mitigating piece. You buy companies that's on a discount. You buy companies that's smaller in value or smaller in market capitalization. They don't have this upside ceiling yet. But make sure they are not small and cheap for a reason, because you do get small and cheap companies for a reason. And how do you make sure they are not small and cheap for a reason? Make sure they're profitable. So you combine those three and you do get a common sense approach to just optimizing your index. It's still a broad market approach without looking into the crystal ball of what's going to happen next.
So I want to come back. I know you say I would ignore country. In other words, because you say I would ignore the domicile, where the company is publicly listed, because you might have U.S. companies who generate income from around the world, and B, you have Chinese companies, Alibaba, for instance, and we've seen that in the UK, for instance, the biggest technology companies that we have, the one big technology companies, outbreak that we have in the UK, or breakout that we had in the UK, end up listing in the US. So you say I would ignore the US, but people still make this case that even if you approach it the way you have, you will still end up with anything from 55% to 65, maybe 70% of your portfolios in the US. And then they bring in, is that diversification? Are you diversified if you have, let's say 60% of your portfolios in the US, you're exposed to that almighty currency risk, dollar. Let's talk about that.
That's an argument I can actually attain. I can actually engage with that argument because it is fair. If you I always tell people to explain it in very simple terms, and we've seen that this year. Had clients asking us, well, the S&P 500 is up 8%. Why is my S&P 500 fund down 4%? And I always explain it to people. You have to think of any investment as, and don't quote me because it's not technically correct, but you have to think of it as two separate assets. The one asset is the asset that you buy, an Apple stock. The other asset is the currency that you are denominated in, dollar in the case of Apple. If Apple stocks goes up and the dollar goes down, they are going to subtract from your returns. If Apple stock goes up and the dollar goes up, you get that double whammy effect, which you've seen in the last couple of years, especially 2022 upwards. So the argument becomes, what about currency movements? So what's the impact of currency movements? Because yes, that can have a detrimental impact on your financial position. And I would agree to that. It does make sense to sort of consider your currency exposure. It does make sense to hedge short-term liabilities. What I would say is people often say we have to hedge out our currency risk. I don't think you can hedge out your currency risk. You can hedge out your foreign currency risk, but then you are exposed to the sterling. Given my South African background, do you want to hedge out your foreign currency risk for the South African rand? I don't think so. I don't think the South African rand is going to appreciate to the same level as the sterling. I know it's not going to do based on common economic fundamentals. But so you have to ask that question. In the UK, you could make the argument that you want to hedge out some of your currency risk. But then how do you do it? Do you really have to do it with the growth part of your portfolio? The part that you are chasing returns with? And I can talk about why I think you shouldn't do it over any meaningful time period. But then if you're going to look at short-term liabilities, my financial retirement success rate, my withdrawals that I want to make, you can justify a bit of home bias in your fixed income part of the portfolio, your defensive part of the portfolio. And then within fixed income, it doesn't make sense to take on currency risk because that second currency or the second asset, that currency has a volatility of almost 20%, but your fixed income asset has a volatility, and volatility is a moving thing, but has a volatility of about 6%.
Right.
So why would you take on that currency risk? Get rid of the currency risk, have your fixed income asset hedged back to sterling, rather accept your sterling risk than within your fixed income part of your portfolio. Within equities, it's really, and I would challenge you to find me an academic research paper that has found a trend in currency movements. There was actually one study that I came across one time where somebody it took 80 years of the sterling dollar, relationship or exchange, and trying to find trends in how it's moving. And they have actually completed their study and say over this 80-year time period, you can actually find a trend and you can find statistical significance. And then when it was peer reviewed, they just extended the sample by I think another 10 years. It completely fell through. So there is no trend in currency movement. It's a random walk. And if there are some academic explanations, like you've got all these highly complicated purchasing parity or PPP explanations for how currencies should move, that will reflect in your returns as well, because interest rates are going to be higher, interest returns are going to be higher. Your real return is going to stay the same. So I'm not concerned about currency movements over the long term in my growth side of the portfolio.
In your equity side of the portfolio. So that's a very deep analysis, yeah, right? I come at this from a very simple approach, which is and I agree with you that you hedge the currency currency risk in your, fixed income sleeve of the portfolio, and you let it run in the equity side of the portfolio. You know why? Why I think that? One is I step out. You're absolutely right. You are exposed. If you then hedge the your equity content back to sterling, then you are taking on sterling risk. And that it could go both ways. Whereas I say, well, look at foreign trade, international trade today. Something like 70% of international trade still happen in dollars.
US dollar.
58% of reserve currency, the world reserve currency, is still in dollar. I think I will take my bet.
It goes even further than that. You're from Nigeria. Imagine you contact a broker in Nigeria and tell them you want to buy Mexican pesos.
Yeah.
He will do it for you, but what's he going to do? He's going to take the Nigerian currency, buy US dollar, and cross trade that with Mexican peso.
Yeah.
If you take that into consideration, then financial trades or the US dollar is involved in about 90% of financial trades globally. So you have a fair argument there. The US dollar is, I think, a pretty safe bet to be in.
And what is the alternative? If you my thinking is by holding by not edging out currency in your equity sleeve, you would have, call it a diversified approach. So you would hold broadly, 60% of your equity in dollar, 4% in sterling, the others like that. So you are exposed to that broad diversification but it is broad because it's in line with how the world works. What is the alternative? You edge everything back to sterling, and you will be, super exposed in addition to your expenditure risk, but you would then be exposed to the vagaries of the UK government.
Exactly that. What I've seen some people do is they would build out a portfolio, and instead of having everything in an unhedged developed world or US equity index fund, they will maybe split it out and say 20% of my US exposure is now going into a currency hedged equity fund. It's a very good reason why it's very difficult to find those funds, because I think that's the one consensus that we have, is that hedging out currency risk is just sort of a fool's game in the industry. It's more, I think, for short-term speculative traders, and maybe if you want to be able to sleep at night, if that's your biggest concern in life, then you can use those funds. But you don't find it because currency hedging in equities doesn't add return. I think, and then if you do that, let's say you take out 20% of your 60% US holdings, and then as you said, you bring that to the UK. Isn't 20% sterling exposure a bigger risk than, let's say, 60% US exposure? Because 20% of global trade is not happening in sterling.
All right.
So now we are starting to talk about what is your risk? What is your biggest risk?
Yeah. The other angle to this is military might and debt, right? So people don't talk about this, but again, one reason I feel comfortable holding a lot of my equity portfolio in the US is the US till today is the global hedgement. It has the biggest military power in the world. Did you see this recent Trump show where he was calling the president and prime ministers of each country. And he says, UK, where is the UK? I mean, people will hate this podcast, right? Because they think I am talking down the UK. But the reality is that, this country has, the US has the biggest military might. You can talk about Russia and China. Russia can't even defeat Ukraine. Of course, they've been back. But my point is that, so you think about, the military might, you think one thing that people often talk about is US debt, getting out of control completely. But again, what other country in the world today doesn't have some sort of serious problem with debt level? Developed countries.
That's it's a fair argument, and I think the argument goes to, what if there's a second reserve currency, or what if there emerges a second reserve currency? And based on your arguments, I don't think it will happen, because first of all, the one thing you do need to be able to get a reserve currency is property rights. China is a long way away from giving us that level of political stability to get a new reserve currency. Who else is going to be? It's not going to be the euro. And as you've said, this is not to sort of talk down on the EU and the UK, and it will be in both of our benefits to have a very flourishing UK equity market. I'd love the UK.
I pray for that.
Imagine we can have a situation where the UK is 20% of the global market cap.
We used to be.
That would be a great place to be. Unfortunately, that's not the reality today. And based on that, talking about debt levels. So if you have to think about your percentage of debt to GDP, yes, it's elevated in the US, but it's probably the one country where I'm not concerned about at all. There's a lot of noise about it in the news as well. But what's going to happen? The US, all trade is in US dollar. All their debt is in US dollar. They can just print more US dollars to a very large extent. I don't think there's a limit where they can't do it. But let's say they reach that limit, and the debt is being assessed to be super risky. Credit ratings assess US debt to be low quality. The rates climb, the prices fall to rock bottom. What's the US going to do? They're going to buy back their own debt and delever themselves. So it's sort of a circle. And I think because they've got this reserve currency, they've got a little bit more leeway than the UK and the EU. I think for the UK and EU, the only thing that's going to save us is, as you've said 2 weeks ago, economic growth. But the US got the US dollar piece is actually a bit of a saving grace.
But also, I think that the bond market keeps the US government honest, because if you look at what happened during
it keeps all governments honest.
It keeps all government honest. Yeah. So, I get all these debates, and you start to dig deeper. We just come back to where we started, which is that the global cap weighting is the collective wisdom of the crowd, and I say it's an intelligent crowd. Absolutely. Who are voting with their money, and it's such a high bar that you have to reach intellectually to say, Laurentius from Wimbledon, like Abraham from Essex is going to diverge significantly away from that, because what do I know? What does that guy on Twitter or, know that this collective crowd doesn't know?
I fully agree. Again, you can play a bit of a devil's advocate in saying that the collective out there is there for one reason, and that's to get capital growth. And I fundamentally believe that is what it should be. And that's why I like the global market cap. You can now find a manager and say, well, we need to position ourselves to be whatever, defensive or preserve capital, or I have a some other objective that I have to follow. And then you could probably justify having something else. But then you first need to be able to justify your objective then. What is your objective? If your objective is then capital preservation, again, the markets probably isn't right for you. You probably need a much lower exposure to the markets. I don't think the answer then is buying different equities, it's buying different assets. And I think that's where you have to distinguish as well. I've heard a lot of people talking about, well, I'm not just chasing returns over a 10 or 20 year time period. I have to think about my returns over a 3 to 5 or 7 year time period. I don't think other companies is your solution. I think other asset classes is your solution.
Yeah. So let's not go into that. I mean, we can start talking about gold and all these things. I'm just trying to think whether I've missed something. Sorry, we do know, just to start to wrap this, we do know, though, that at some point there is going to be some sort of market correction. And if you have this global exposure, you will be impacted by this. I will argue that, even if you take this, I want to call it more theoretical view, and you diversify away from the UK and you hold more developed markets ex-UK. What do we know about correlation between European and you diversify away from the US. I mean, what do we know about correlation between US and global developed ex-US markets?
That's a very fair point to address. I think, especially in the UK, you get so many people that sit with a 20% or 25% UK-owned bias, and you ask them why. What's the thinking behind that? And they will tell you, well, we have to diversify away from the US given the valuations. We are just so much more comfortable sitting in a 25% exposure to the UK and maybe a 20% exposure to the EU. And that I find that somewhat amusing, because the UK and the EU, especially UK and EU large cap stocks, are the highest correlated market with the US.
Yeah.
If you really want to diversify away, go and buy emerging market stocks. They are somewhat less correlated than UK and EU stocks. So that is an argument that I think really doesn't stack up when people come to you with a UK or an EU bias because they want to underweight the US, because the correlations are very, very high.
It's been fascinating having this conversation with you. There are lots of things that I would love to get into. Private equity side of things. Maybe even we can touch on other asset classes. Gold. I
think that's a can of worm we don't want to open. But let's see how it goes, Abram.
Is there anything I've missed in this conversation about global cap weighting from the equity side of things? Is there anything we haven't touched upon?
No, I think in terms of the global market cap, just to reiterate, it's as you said, it's the collective wisdom of the market. It's a very dynamic position. People often say, and that's sort of one of the things that gets me the most, if they tell me the tracker portfolio or a global market index, it's a lousy static way to invest. It's so dynamic. It's currently 62%. If you think back, it's not unprecedented. The US has been at 60%. I believe it was in the late 80s. It has been at 72% in the late 70s. It has been in when was the Japanese stock bubble? In the 90s.
Yeah.
The US was 29% and Japan was 32% of the global market. It's a very dynamic position. And that is sort of based on the whole efficient market hypothesis of saying capital is going to migrate to where investors are expecting the highest returns.
Yeah.
And if you look at the risk involved in that, it's a decent portfolio. It manages your risk, because investors are not blind of risk. They are not just chasing returns. They are looking at the risk of these portfolios. So at the end of the day, a global market cap approach, you get where investors are expecting the highest returns with a reasonable amount of risk. And we've seen the outcome of that. The markets has been the greatest wealth creator of all times. I always tell people there's probably just one company that has been more profitable than the markets, and that's probably the Vatican. But other than that,
you can't buy that.
The markets has been the most profitable or the best wealth creator of all times.
And I think that's where we will leave this, to misquote the legendary Winston Churchill. Global cap weighting is the worst form of equity investing, except for all other forms. Laurentius van der Boom, thank you very much for your time. Thank you for your wisdom. I've really enjoyed this conversation. Thank you.
Likewise. Thanks, Abram.
That's a wrap on today's show. Massive thanks to my production crew, especially Jake Osha, Melissa Canham, and the entire team. And of course, to our sponsor, Timeline, the market-leading provider of integrated planning technology and model portfolio service to advisors. I do hope you've enjoyed today's show. Head over to Apple Podcast and give us your review there. Until next time, goodbye.